You know, every great business, whether it's a tiny cafe on the corner or a massive tech giant, eventually runs into the same problem. To get bigger, you need money. You need capital. But where on earth does that money come from? Okay, let's jump right into this core challenge and explore the two main roads a company can take to fuel its growth.
So you've got this brilliant idea, right? The plan is solid, the vision is clear, but you need cash to actually make it a reality. This is the question. It's what keeps founders staring at the ceiling at 3 a.m. And look, there's no easy answer here. The path you choose is going to define everything about your company, its future, its risks, and yeah, its potential rewards.
At the end of the day, it really just boils down to this one fundamental choice. In one corner, you've got equity. This is where you sell off pieces of your company, bringing in partners who are going to share in both the risk and, hopefully, the profits. And in the other corner, you've got debt. This is where you just borrow the money. You keep 100% ownership, but now you've got a bill that has to be paid no matter what.
All right, first up, let's talk about team ownership. This is the world of equity financing, and the big idea is actually pretty simple. You're trading a slice of your company's pie, a piece of the ownership, for the cold, hard cash you need to grow right now.
Now, the most basic way this happens is with something called common equity. Whenever you hear about people buying stocks in a company, this is usually what they're talking about. These shareholders, they're the real owners of the business. And that ownership comes with a very important job title, primary risk bearer.
So what's the deal for these common shareholders? Well, it's fascinating. They get control, they have voting rights, and they get to elect the board of directors. But, and trust me, this is a huge but, they are what's called residual claimants. Think of it like this. The company is a big dinner party. The common shareholders only get to eat after every single other person has filled their plate. The lenders, the suppliers, everyone. And if the party's over, if the company shuts down, they are dead last in line to get paid back.
But you know, not all equity is the same. There's another flavor called preference shares. You can think of these as a kind of hybrid, sitting somewhere in the middle between a pure loan and pure ownership. These guys are owners for sure, but they come with some special VIP perks that really set them apart.
And this chart lays out the difference perfectly. See, common shareholders get the vote, but preference shareholders? Usually not. But in exchange for giving up that control, they get a fixed dividend that has to be paid out before any common shareholder gets a single penny. And in that worst-case scenario, if the company goes under, they get their money back before the common shareholders do. They get to cut in line.
So with all that, what's the catch with equity? Well, this quote really says it all. Every single time you issue a new share, you dilute the ownership of everyone who was there before. The total pie might be getting bigger, but your personal slice of it just got a little bit smaller. You are trading control for cash. All right, let's switch gears and head to the other corner of the ring, team loans. This is all about debt financing, and here the trade-off is absolutely crystal clear. You get to keep 100% control of your company, but you are signing on the dotted line for a legal obligation, a bill that is always due.
And this is the most important thing to get. When you take on debt, the lender is a creditor. They are not an owner. They've given you money and you have a contract that says you have to pay it back. They don't get a vote on how you run the business. And if you hit a home run and make massive profits, they don't get a piece of that upside.
So the deal looks something like this. You give up zero ownership. That's the huge, massive advantage. But in return, you now have a non-negotiable legal duty to make those loan payments. If you miss them, you could be looking at bankruptcy. There is a nice little bonus, though. The interest you pay on that debt is usually a tax-deductible expense, which actually lowers the real cost of borrowing.
Okay, this brings us to one of the most critical questions in all of finance. What happens if everything goes completely wrong? If the company fails and has to be liquidated, who gets their money back and in what order? This is called the repayment pecking order, and it basically defines the risk for every single person who put money into the company.
And here it is, the pecking order. Right at the very top, in the safest spot, you have the senior debt holders. These are your banks, your secured lenders, they get paid first, period. Then you work your way down through other types of debt and hybrids. And take a look at where our owners are. The preference shareholders are way down there, second to last. And at the absolute bottom of the barrel, taking on the most risk, the common equity shareholders, the owners. They get whatever is left, if anything is left at all.
So, knowing all of that, how in the world does a company actually make this choice? It's not a coin toss. It really comes down to a set of key strategic questions that every founder, every CEO, every CFO has to be able to answer.
First up, cost, because all money has a price tag.
With debt, it's pretty straightforward, right? It's the interest rate. With equity, it's a little trickier. It's more of a promise. It's the return on investment that your new partners, your shareholders, expect you to deliver for taking a huge gamble on your vision.
Next, let's talk about risk. And this is all about your cash flow. If your business brings in a steady, predictable stream of money, you can probably handle the risk of a mandatory debt payment every month. But if your income is all over the place, like a lot of startups where one month is a feast and the next is a famine, then equity might be a safer bet, simply because you don't have that fixed bill hanging over your head.
And then there's the big one, control. For some founders, this is everything. Maintaining 100% control over their baby, their vision, it's just non-negotiable. If that sounds like you, then debt is probably your best friend. But if you're open to bringing on partners, maybe for their expertise as much as their money, and you're willing to give up some control, then equity is the clear path.
And finally, you have to remember you're not making this decision in a bubble. What's the wider market doing? If the stock market is on fire and company valuations are through the roof, that's a fantastic time to issue equity and get a great price for it. On the flip side, if interest rates are at historic lows, then borrowing money through debt becomes incredibly cheap and very, very attractive. You got to play the field.
Okay, so you've weighed all the factors, you've made your choice. But the story doesn't stop there. How you decide to fund your company has a huge impact on how you actually measure performance and, at the end of the day, how much wealth is really created for the owners.
Now here's a concept that might just blow your mind a little bit. It turns out that using debt, using borrowed money, can actually supercharge the financial returns for the owners. This powerful idea is called leverage or trading on equity. It's like using a tiny lever to lift something way heavier than you could on your own.
Let's use a quick example from our source. Imagine a company that's funded completely with equity, 100,000 shares. After they pay their taxes, their earnings per share, or EPS, works out to 1.4. Not bad. It's a solid, respectable number.
But now check this out. Same exact company, same profit, but this time it's funded with a mix of debt and equity. Because the interest they pay on the debt is tax deductible, and because there are fewer owners to split the profits with, the earnings per share skyrockets to 2.1. That's the magic of leverage. But you gotta remember, it's a double-edged sword. If profits go down, leverage will amplify your losses just as fast.
And all of this leads to an even bigger question. How do you even define success? The traditional way is to just look at profit. It's simple, sure, but it's kind of like judging a race car's speed without thinking about how much fuel it's burning. The modern approach is a lot smarter. It asks a better question. After you've paid for all of your funding, both the interest on your debt and the return your shareholders demand, is there anything left over? That is the true measure of whether you're creating real long-term value.
And that's really the final thought we're left with. This whole debate, debt versus equity, it's not just a transaction on a balance sheet. It's a deeply strategic decision that forces you to answer a really tough question about your business. Is your goal just to maximize the profit number you see this year? Or is it to build something that generates true, sustainable economic value long after the total cost of your funding has been paid?